Hello. Uh, okay, here in Australia at the moment, and pretty much everywhere across the planet, we're all experiencing the phenomenon of high inflation. I'm sure that we're all finding a bit of that going on at the moment. We're probably all a bit worried, a bit tense about it. And as a result, all of those central banks in all of these countries, they're raising their base interest rates. And as a result, those of us that are on variable rate mortgages or we've defaulted to the variable rate on our mortgages, we're seeing those mortgage rates and our monthly mortgage repayments lift before our eyes. And seeing and hearing this from many people I'm talking to at the moment, a lot of people are scrambling at the moment to go and fix their interest rates. But is fixing your interest rate actually the right decision for you? Anyway, I'm Michael Scarbossa. I'm a personal finance enthusiast. I have a career in railway construction, and my goal is to make money simple by sharing simple, actionable steps and strategies to help you grow your hard earned money and shortcut your path to retirement. So, I created this community, Save and Invest and Grow Your Money, so I can share what I've learned over the last 20 plus years to help you achieve financial strength for yourself and for your family, to help you along the path to make better decisions, ask better questions, get the right advice so you can have more success on your financial journey. So I'd also like to share, go to my website. I'll put a link in the comment below this video at michaelscarbossa.com. I've got a free PDF there for you. Me explaining how I went from no savings to buying my first investment property. I think you would find it really useful to go and grab that and have a look. There's a small plan in there for you to be able to get some steps around to start moving forward. Anyway, so getting back to today's topic, is fixing your interest rate on your mortgage or your loan the right decision for you? Well, it really depends on your current financial situation and if you just have a little tiny appetite to risk, which can be mitigated, by the way. Um, Now, when banks fix their interest rates, okay, what that essentially means is banks are taking on the future risk of the cost of their own financing to be able to give you a loan. So what does that mean? Well, the banks, okay, they are looking into the future and making their best predictions of what the interest rates, the central bank interest rates are going to do, which will impact the cost of their financing to provide your loan, which I just said. Now, what that means is they're going to then, they don't have a crystal ball, so they any risk that they see around that, they're going to build that into your fixed interest rate loan. So you're actually going to pay for that risk. So just think about it. The banks, you know, our big banks and lenders, even though as sophisticated they may seem, they do not have a crystal ball. Okay. So their future predictions on interest rates are their best guess of what's going on at the time. Now, particularly in the last 12 months, this has actually changed quite dramatically on their outlook. So if you go back towards the end of last year, yep, everyone was predicting interest rate rises were coming. No one was predicting the magnitude that they were going to come at or the magnitude of inflation that was going to hit us. That was not public knowledge. It didn't seem to be common knowledge. I didn't see it at the end of last year that what we're experiencing right now. So all the way back then, what they were predicting, their future fixed interest costs might not have been so big, but it was fairly uncertain. Okay. So move forward a few months into earlier this year, and inflation was starting to hit hard. Interest rate rises from central banks was starting to come hard and heavy. The banks were pretty pessimistic, and their fixed interest rate loans that they were offering were reflecting that. They were quite high cost, well above 5%, is what you're seeing. Now, fast forward to today, as we're speaking right now, things are just starting to settle down just a little bit, and you're seeing that with lenders starting to decrease the future cost of their fixed interest rate loans. So what we saw a few months ago, some of those fixed interest rates are just coming down just a little bit. So, all in all, what I'm trying to explain is if banks are going to fix an interest rate for you into the future, they are taking on that risk. They are going to make sure that they're covered. They don't want to lose money. They want to maximize their profits. They're not going to, they're going to make sure that you're covered. There's going to be a little bit of conservative in those rates, and you're going to pay for it. It's as simple as that. Okay. So think of it this way. Think of it like a casino. Okay. So with casinos, we know that the house always wins. The odds are stacked, ever so slightly in the house's favor, and eventually they will get you. They will win. Think of the big banks as the same. It's no different. The big banks are the house. They're going to win. They'll beat you every time. Um, now, um, even with all that, the banks didn't have a crystal ball. But if you manage to fix your interest rate for 3 or 5 years, probably 18 months ago, you might have actually got arsey and got yourself a good deal. But I just see that back to the casino analogy again. That's just a bit of gambling, and no one's got a crystal ball, and no one can predict the market. But if that's the approach you want to take, then good luck to you. It's certainly not an approach I take. Anyway, so knowing all of this, what do you do? Do you fix your interest rate or not? Well, like I said previously, there's a couple of things to consider. How far can you push your finances before it breaks you? Um, how can you live with a little bit of uncertainty around your mortgage interest rate rises if you're on a variable loan? And how can you mitigate that? Okay, it comes with a little bit of appetite to risk, but you can mitigate it and give yourself some peace of mind around this. So now I hear what you're thinking though, right? A variable rate mortgage sounds pretty scary. You're probably thinking, I'm struggling with money right now. The thought of my mortgage repayments continually going up and not knowing when that's going to happen, that uncertainty actually sounds like it's just going to be too much to handle and a bit too much to bear. Now, you're probably thinking, I can't live that uncertainty with my mortgage rate. I at least want to know where I stand and I want to fix my interest rate. Well, let's just explore that for a moment, okay? Because the flip side of fixing your mortgage interest rate is you're going to pay a higher rate percent. Okay. So essentially, it's going to cost you a bloody bomb. So if you want to go and flush that money down the toilet, be my guest. But if you really struggle with that uncertainty, you really need that peace of mind, and you want to pay that premium, then that's the decision that you've got to take. Now, let's just think about that for a moment. Okay. So I'll just go. I live in Australia, so I'll use an Australian example here at the moment. And the majority of variable rate mortgages in Australia at the moment, right now, as we speak today, you can pick up a deal. If you've got 80% loan to value of your house, so you only need a mortgage to 80% of the value of your house. You can there's plenty of deals out there you can pick up for around 3 to 3.5% per annum interest rate payments. Now, on the flip side, a fixed interest rate mortgage, what I'm seeing at the moment is at least 5%. So we're talking 5.5, 6%. So that's a pretty big difference. That actually represents you fixing your mortgage interest rate and not going with a variable rate. You're basically paying a 40% premium every month on your mortgage payments. That's a hell of a price to pay for a bit of certainty. A hell of a price to pay for some peace of mind. And I think there's a smarter way to go about it. Okay, you might carry a little tiny bit of risk, but hey, there's certainly a smarter way to go about it. Now, if you do decide to go down the path of variable rate interest rate loan, what I recommend you do, and this is the smart way to do things, or what I believe is the smart way to do things, is create yourself a mortgage rate increase, interest rate increase buffer. Okay. So what that means is, think about it. If you're going to, just let me check something here. Yep. So if you're going to go down a fixed interest loan, you are going to fix in 5% or more for your interest rate, no matter what. Okay. So you're going to take the decision, you're going to find a way to adjust your living, and you're going to go and pay that. And that's all going to the bank. Now, if you're stuck with a variable interest rate loan, you manage to get one at 3%, probably more likely around 3.5%, then that's quite a big difference, 3.5 to 5%. Like I said before, it represents about a 40% premium on your payments. So that's a lot of money. So what you do, right, is you create yourself this mortgage interest rate increase buffer if you go down the path of a variable loan. So you just imagine that you're okay, if you're going to pay that fixed interest anyway to 5%. So the difference of what it was going to be between what you're actually going to pay to the bank at, say, let's say 3.5%, and what you would have paid at 5%, take that money now, set yourself up a separate mortgage interest repayment savings account. Okay, so whatever you want to call it. When you get paid every month, or fortnightly or however you get paid, set up a direct debit to that account for the difference that you would have paid if you went down a fixed rate interest loan mortgage every month. And what you're doing, right, is you're adjusting your living to that payment anyway, but you're keeping that money in your pocket. You're not paying that to the banks. Okay. So that's a pretty smart thing to do. All right. Pay it anyway, but pay it to yourself. And then you keep the buffer in your pocket, not in the bank's pocket. Now you might be thinking, okay, 5%, yeah, but what if it goes beyond that? I don't have a crystal ball either. Well, it might go beyond that and may very well go beyond that. So this is the little bit of risk you've got to live with. And what I would recommend is you don't stop at 5% in regards to creating your interest rate buffer savings account. Maybe ratchet that up to if your fixed rate mortgage was going to be 6%, or interest rates could go to 6%, or whatever number that actually just makes you feel comfortable, to be honest, because this is money that you're putting aside for you, for your own buffer. So that's what I recommend you do. That is my smart decision around variable interest rate mortgages. Now, that is exactly the approach that I've taken with all of my mortgages, and I have numerous mortgages because I have a number of investment properties. I have plenty of reasons to feel uncomfortable about this, but I feel very comfortable with the approach that I've taken because I know that I have this buffer, and if interest rate rises, I'm pretty comfortable that I've got things covered. Now, yes, it is a calculated risk because I don't know how high interest rates are going to go, and neither do you. But personally, with everything I'm looking in the market, I believe it's a low risk. It's calculated and it's low. Now, how do wealthy people make money? They take small calculated risks where they believe there is low downside risk but strong upside risk. And what's the strong upside risk here? Well, you're keeping that buffer in your pocket, and it may be a buffer that you may never even have to tap into, or not to the level that you think that we're putting away to tap into. Okay, it could go beyond that, but I think it's a very low risk, and I'm willing to take that bet for myself, essentially. So I hope you found that really informative. I think what you will get from this is by taking things in your own hands, you'll create some self-esteem around, taking the power of that decision in your own hands. You're going to be putting that money away for the future. You never know, you might not need it, or you might have a nice little nest egg there in the future that you can then go and invest smartly in another way. So it's going to be, I think, a pretty good advantage for you. And it's just a smart decision. Who knows when our interest rates will settle into some consistency, but when you get there, then you might have some options because you've taken the hard decision now. You've kept the money in your pocket. You created yourself a buffer, and you've given yourself some confidence around making some decisions around money. Okay, so that's it from me today. I hope you found that really informative. I hope I've given you something to think about and go and explore. And I hope whatever you decide to do, I hope you get great results from that. Once again, I just want to remind you about that free PDF. I'll leave it in the link, but leave the link to my website below, michaelscambossa.com, of how I went from no savings to buy my first investment property. I think you'll find that really interesting too. If investing in property is a path that you want to go down. So thanks very much. Thank you for listening, and I look forward to chatting you all next week. All right. Bye for now.